So look at the next topic, approach with taxation. So yesterday's class we were discussing approach without taxation. Approach without taxation was a relevant theory or irrelevant theory? Irrelevant theory, which was similar to approach without taxation. It was similar to net operating income approach, where cost of capital of the companies will remain constant and value of the firm will remain constant, but cost of equity will be increasing. Why? Because of the increased financial risk. Next, approach without taxation. First, it is a relevant theory or a relevant approach which says that if a company is changing the capital structure, then value of the firm will also be changing, right? So first, no. So approach with taxation. Listen, one of the assumptions that we made in the first 4 theories of capital structure was we were assuming no tax world, right? But here we are going to deal with taxation. Now let's say there are 2 companies, A Limited, which is a levered company, and B Limited, which is a unlevered company. In case, so first, what is a levered firm and what is unlevered firm? Levered firm means it uses both debt as well as equity in the capital structure. Unlevered firm uses only equity in the capital structure. Now here we are dealing with taxation. Now you tell me this tax will benefit A Limited or B Limited. Which company will be benefited because of tax? Why? Because A Limited is going to pay interest to the debenture holders. Interest is a tax deductible expense. So value of which company will be greater than value of A Limited will be greater than value of B Limited. To put it very simple, value of levered firm will be greater than value of unlevered firm in case of approach with taxation. So that is the first point you can see over here. Levered firm will have additional savings in the form of taxation. So as a result, value of levered firm will be greater than value of unlevered firm. Clear? Any doubt on this? Now look at the impact. Overall cost of capital of the levered firm will decrease on account of savings in taxation. So here, what is the formula for calculating cost of debt? In irredeemable debt. In this chapter, we are going to discuss only irredeemable debt, no redeemable debt. Cost of calculating cost of irredeemable debt, I into 1 minus T, right? Assume net proceeds is 100. So in that case, you can directly calculate. You remember, if debentures are issued at face value, cost of calculating irredeemable debt is nothing but I into 1 minus T. In the denominator, if you are taking 100 also, it is going to give you the same percentage. I hope you are all getting the point, right? Now this is the formula for cost of debt. Now in this case, what is happening? Cost of debt is decreasing because of taxation or increasing because of taxation? Cost of debt is decreasing because of taxation. So as a result, overall cost of capital will decrease. So we can say that cost of capital of levered firm will be lesser than the cost of capital of unlevered firm. Is this part clear? Now why value of levered firm is greater than value of unlevered firm? Because cost of capital of levered firm is less than the cost of capital of unlevered firm. This is what we studied at the beginning of the chapter. Why capital structure is important. We have to design the optimum capital structure, and that optimum capital structure is the point where cost of capital is minimum and value of firm is maximum. So there is an inverse relationship between cost of capital and value of the firm. So that is what we studied over here. Overall cost of capital should be minimized, because of which value of the firm will be maximum. So in approach with taxation, cost of capital of levered firm is lesser than the cost of capital of unlevered firm. Why? Because of tax savings on interest. So value of levered firm will be greater than the value of unlevered firm. Clear? Any doubt in this? So till this point, we discussed. Now look at the formula for calculating value of firm in approach with taxation. Approach with taxation. So listen, we have to calculate. See, first let me tell you one thing. In your exam, if they are asking us to calculate, if they are asking you to solve any question based on approach with taxation, you just need to follow the steps. First step is to calculate value of the unlevered firm. Now, how do you calculate the value of unlevered firm? Generally, what is the formula for calculating value? One more formula, alternative formulas. EBIT divided by cost of capital. But here you cannot use this formula. Why? Because taxation is there. From EBIT, what do you need to subtract? But it is an unlevered firm, so there is no interest. So you can directly multiply EBIT into 1 minus T. If you multiply EBIT into 1 minus T, what do you get? PAT, no, profit after tax, right? So value of the unlevered firm should be calculated using this formula, EBIT into 1 minus T divided by KO. Any doubt in this part? Clears? Did you all understand why we are multiplying it with EB into 1 minus T? Any doubt in that? Clears? Now second step is to calculate value of the levered firm. Now listen, in approach with taxation, value of levered firm will be greater than value of unlevered firm or less than value of unlevered firm. So value of levered firm should be something greater than the value of unlevered firm. So value of levered firm is equal to value of unlevered firm plus tax savings. Now listen. So value of levered firm is equal to value of unlevered firm plus. So we have. Generally, how tax savings will be calculated? Okay, let me put it in this way. Tax savings on interest. That we need to mention. Tax savings on interest. So generally, how do we calculate tax savings on interest? We did this in cost of capital chapter also, right? Interest is there. If you multiply interest with 1 minus T, we get cost of debt. If interest is multiplied with 1 minus T, we get cost. If interest is multiplied with T, we get tax savings, right? But here we should not write, don't write it, just listen. We should not take interest into tax. Why? Because this interest is nothing but an annual figure. Interest is an annual figure. Interest is paid on an annual basis, right? So instead of multiplying interest into T, we should multiply debt into tax rate. Now why? What is the logic behind this? Listen, this debt is nothing but present value of all future interest payments, right? So I can call this debt as this debt is nothing but a bundle of interest. So if an investor is purchasing a debt instrument today, in future what he is going to get? Interest. Who is going to pay this interest? The company is going to pay interest. So first year the company will pay interest, second year they will pay interest, third year they will pay interest. So they are going to pay interest for an indefinite period of time. So when you collect all these future interest and you bundle it, that bundle of interest is known as debt. So the tax savings on interest is calculated as debt into tax rate. Is this part clear? Any doubt in this? Clear to everyone? Or you want me to explain it again? Got it? Clear? So what is the formula for calculating value of unlevered firm? Value of levered firm. It is value of unlevered firm plus debt into tax rate. So write down the formula. Value of levered foam is equal to value of unlevered foam plus dipped multiplied by tax rate. Copy it down. Everyone done till this part? Any doubt so far? Clear? Now listen. So in approach with taxation, first step is to calculate value of unlevered foam, then value of levered foam. Third step is to calculate cost of equity of the levered foam. Now here listen. Without calculating cost of equity of unlevered foam, why we are directly calculating cost of equity of levered foam? No, actually you can calculate cost of equity of levered foam using cost of equity of unlevered foam. But here we are not calculating the cost of equity of unlevered foam. Why? Value of the... See, first it is an unlevered foam. Do they have any debt? No. So what is their cost of capital? Equal to cost of equity. So this KO we are writing. No, this KO is nothing but KE as well. I hope you are all getting the point. It is an unlevered foam. They don't have any debt. So cost of capital is equal to cost of equity. Clear? So now cost of equity of levered foam is equal to, in approach without taxation, how did we calculate the cost of equity of levered foam? Yesterday we discussed one formula. Profit after tax. That is net income approach. I'm talking about MM without tax. What is the formula for calculating cost of equity of levered foam? Cost of equity of unlevered foam plus cost of equity of unlevered minus cost of debt into debt by equity. You all remember this formula? Yesterday we discussed it, right? Now here, this is the formula for calculating cost of equity of levered foam in approach without taxation. In case of tax, what do we need to do? You just need to multiply this debt with 1 minus t. That's all. Clear? Any doubt? Yesterday itself we discussed the logic behind this formula. Clear? Any doubt in this? Now listen. While calculating costs, we are multiplying debt with 1 minus t. While calculating value, we have to multiply debt with tax rate. So savings, for calculating savings, interest into t. For calculating cost, interest into 1 minus t. So that is what we are doing here also. Clear? Any doubt in the formula? Clear? So next, fourth step. Now fourth step in approach with taxation is to calculate cost of capital of which company? Levered or unlevered? Cost of capital of levered company, right? Because unlevered it will be given in the question, which is nothing but cost of equity of the unlevered firm. So fourth step, calculation of cost of capital of levered firm. So how do we calculate cost of capital of levered firm? Same, like we have to write source, funds, weights, cost, then weight into cost, add everything. Similar to what we did in cost of capital chapter. In cost of capital chapter we calculated WACC, no? So similar to that, here also we have to calculate cost of capital of levered firm. Clear? So for all the questions approach with taxation, these four steps have to be followed. Right? First, what is the first step? Calculate value of unlevered firm. Formula is EBIT into 1 minus T divided by cost of capital. Second step, calculate value of levered firm. Value of unlevered firm plus debt into tax rate. Third step, calculate cost of equity of levered firm. Formula is cost of equity of unlevered plus cost of equity of unlevered minus cost of debt into debt by equity into 1 minus T. Fourth step, calculate cost of capital of levered firm. Now look at question number 11. Blue Limited, an all equity financed company, is considering repurchase of 275 lakh rupees of equity shares and to replace it with 15% debenture on the same amount. First, Blue Limited is a levered form or unlevered form? It is unlevered. Why? Because it is an all equity financed company. So it is obviously a unlevered company. Listen. So Blue Limited is a unlevered firm. Now what they are planning to do is, it is considering to repurchase 275 lakh equity shares and to replace it with 15% debenture of the same amount, which means they are planning to borrow 275 lakh rupees of money by issuing debentures, right? And with that 275 lakh rupees of cash, they are going to repurchase the equity shares. So now after borrowing money in the form of debentures, Blue Limited will become a levered firm, right? Current market value of the company is 1,1750 lakhs. Now what is this 1,1750? Value of which firm? Levered or unlevered? It is value of unlevered. So here first step we don't need to calculate. It is directly given in the question. What is the first step? Calculate the value of unlevered firm. They have directly given current market value of the company is 1,750 lakhs. So value of unlevered firm is directly given. Clear? With its cost of capital of 20%. So this cost of capital is nothing but cost of equity as well. The company's earnings before interest and tax are expected to remain constant in the future years. The company also has a policy of distributing entire earnings as dividend. So if you remember, this is one of the assumptions that we studied. No retained earnings. Whatever the profit generated by the company will be distributed as dividend to the equity shareholders. Assuming corporate tax rate of 30%, you are required to calculate the impact on the following account of the change in the capital structure as per MM approach. So here it is MM approach with tax or without tax. How do we identify that? Because tax rate is mentioned in the question as 30%, right? So what is the first step? Value of unlevered firm. But we don't need to calculate it. It is directly given. So write down question number 11. Value of unlevered firm. It is given in the question 1,570 lakhs, right? 1,750 lakhs. This 1,000. So value of the unlevered firm is given as 1,750 lakhs. So now how do we calculate the value of levered firm? Value of levered firm is equal to, what is the formula? Value of unlevered firm plus debt into tax. So what is the value of unlevered firm? It is 1,750 lakhs plus. Now what is the amount of debt the company is planning to borrow from debentures? It is 275 lakhs. So amount of debt is 275 So let me write it over here. Value of levered form is equal to value of unlevered form 1750 plus value of debt is 275 into tax rate how much? 30%. So what is the value of levered form? 1,832.5 lakhs. Clear? Did everyone get these numbers? Now what is the third step? Third step is to calculate cost of equity. So what is the formula for calculating cost of equity? First, cost of equity of levered form or unlevered form? Unlevered. We have to calculate cost of equity of levered form. Cost of equity of unlevered form is given in the question, 20%. So cost of equity of levered form is equal to cost of equity of unlevered plus cost of equity of unlevered minus cost of debt into debt by equity into 1 minus T. And again one more thing, listen. In your textbook, they have given this formula, D divided by D plus E. This is the formula given in the textbook, which is not actually the right way of doing it. So please don't follow that. The denominator you should take only the equity value, not debt plus equity. So now cost of equity of levered form is equal to, what is the cost of equity of unlevered form? It is 20% plus 20 minus, at what rate we are borrowing this thing, debentures, it is 15%. Into debt is, what is the value of debt? 275 divided by, what is the value of equity? Value of equity. How much? No, you should not take 1750. 1750 is the value of the firm before the debt. That was the value of unlevered. We need to calculate value of equity in levered form. It is very simple. What is the total value of the firm we calculated? 1832.5. Out of 1832.5, 275 lakh is the value of debt. So remaining 1557.5 is the value of equity. Is this clear? Any doubt? If you want me to explain it again, please do let me know. Again, what is the value of the firm we calculated? Second step, 1832.5. This 1832.5 includes value of debt as well as value of equity, because that is the value of the firm as a whole. Now in this question, what is the value of the debt? 275. So if 1832 is the total value of the firm, from this if you remove the value of the debt, which is nothing but 275, we get 1557.5, which is nothing but equity. So 1557.5 is the value of equity into 1 minus tax rate, 0.3. What is the cost of equity of levered firm? The value of equity. 1832.5 is the value of levered firm. Levered firm has both debt as well as equity. Out of this 1832.5, 275 lakh is debt. Then what is the value of equity? The remaining portion, which is 1557.5. Clear? What is the cost of equity of levered firm? 20.6%. Clear? Any doubt in this part? 20.6%. Did everyone get this answer? Done? So now listen, we are done with the first 3 steps. We are left with the last step. What is the last step? To calculate overall cost of capital of the levered firm. So, cost of capital of the levered firm. Write it down. Calculation of cost of capital of levered firm. Calculation of cost of capital of levered Yes, what is it? 20.6%. Did you all get 20.6%? You all got it, no? You didn't get it. 20 minus 5 is 15. Sorry, 20 minus 15 is 5. 5 into 275 divided by, take the calculator, 5 into 275, you are getting 1375 divided by 1557.5, you will get 0.88285 something. Multiply it with 0.7. Why 0.7? Because this 1 minus 0.3 into 0.7 plus 20. Here 20.61% or 20.62, you can round it. Fine, no problem. You are getting 20.617. No, it is better to round it to 20.62%. 20.62% is the cost of equity of levered firm. So far clear? Any doubt? So now we have to calculate the cost of capital of the levered firm. So what is the format? Source, then next weights and cost of individual component. Then we have to multiply weight into cost. Clear? Now here in this question the company has only two sources of finance. One is debt and the other one is equity. What is the value of debt and value of equity? 275 lakh is the value of debt. 1557.5 lakh is the value of equity. So total value is 1832.5 lakhs. So what is the weight of debt and weight of equity? How much? Tell me the percentage. 15. 15% is the weight of debt and remaining 85% is the weight of equity. So total 100%. Cost of debt is how much? Look at the question. What is the cost of debt? Cost of debt. Is it 15%? 15% is before tax. So we need to take the after tax cost of debt. So you should not take 15% directly. Instead, you should take 15% and multiply it with what? 1 minus 0.3. Then please don't ask, sir, while calculating cost of debt, why we did not multiply it with 1 minus t? It is multiplied here. Outside the bracket here we have multiplied it with 1 minus t. Right? So what is 15 into 0.7? We get 10.5. Yeah, 15 into 7 are 105. So 10.5%. So cost of debt is 10.5%. What is the cost of equity? We calculated 20.62%. Now multiply and tell me the numbers. 15% into 10.5% and 85% into 20.62%. How much? 16.5. This one 1.575%. Next 17.527%. So what is the total cost of capital of levered firm? 19.10. 19.102%. Clear? Any doubt in this so far? Did you all understand? Right, now listen. If your cost of capital of levered firm is greater than cost of capital of unlevered firm, then your answer is wrong. It should be less than, cost of capital of levered firm should be less than the cost of capital of unlevered firm. Right? Why? Because of the tax savings on interest. It can't be more than the cost of capital of levered firm. So now just put the numbers in the respective requirements. What is the market value of the levered company we calculated? 1832.5 lakhs. Overall cost of capital 19.102%. Cost of equity 20.62%. See, even though cost of equity is the third requirement in this question, it is always better to do the cost of equity before and then only you can calculate the cost of capital. Clear? Any doubt in this so far? Did you all understand till this part? Now question number 12. See, actually from question number 12 till question number 17, we are going to follow the same 4 steps, and we have to calculate value of levered firm, cost of equity of levered firm, then cost of capital of levered firm. So question number 12, you try to solve it by yourself. Question number 12 also you can try, 13 also you can try, 14 I will do it. So 12 and 13 you try yourself and tell me the answer. So X and Y limited are identical in every aspect. X and Y are identical in every respect except that X limited does not employ debt. So X limited is a unlevered firm, does not employ debt in its capital structure, whereas Y limited employs 10% debt amounting to 4 lakh rupees. So Y limited is a levered firm. So first step you have to calculate value of which company, X or Y? Unlevered, which is unlevered here? X limited. So first step is to calculate value of X limited. EBIT is given 2,40,000. EBIT of both the companies are same, 2,40,000, because that is one of the assumptions that we made. Equity capitalization of X limited is 20%. So what is this 20%? Cost of as well as cost of capital, because it is an unlevered firm. Cost of equity is equal to cost of capital. Assuming tax rate is 25%, assuming that all assumptions of models are met, calculate average value. This average value is nothing but we have to calculate value of both the companies, X as well as Y. Then we have to calculate cost of equity of which company? Levered or unlevered? Levered, which is Y limited. Unlevered cost of equity is given 20%. Then we have to calculate cost of capital of both the companies. But why we have 20% here? So we have to calculate cost of capital of levered firm only, right? So I will do the first step alone for you. From the second step you can do it. So question number 12. What is 9 lakh? Correct. So first calculation of value of Y limited, which is the unlevered firm here. Sorry, X is unlevered, no? Value of X limited. We are calculating the value of unlevered firm first. So what is the formula for calculating value of unlevered firm? EBIT into 1 minus T divided by cost of capital. So what is the EBIT? It is 2,40,000 into 1 minus tax rate is 0.25 divided by cost of capital is 0.2. So 75% of 240. How much? 25% is by 4, 60,000. So 1,80,000 divided by 0.2. So we get 9 lakh rupees is the value of unlevered firm. So from this you can calculate value of levered firm, then cost of equity of levered firm, then cost of capital of levered firm. Do it and tell me the answers. I think
So, 9 minutes, 20% start, 30% finish.
This is the 13th question. You are supposed to calculate what is the value of the firm. Assuming corporate tax rate is 30%, calculate the value of these firms according to my rate. They are not asking you to calculate the cost of equity or cost of capital. Just to calculate the value of both the firms. Now look at 14th question. A limited and B limited are identical in every respect except capital structure. A limited does not employ debt, which means A limited is a unlevered firm. Whereas B limited employs 12% debentures amounting to 10 lakh rupees. So B limited is a levered firm. Assuming that all assumptions of MM model are met, income tax rate is 30%, EBIT of both the company is 2,50,000. Equity capitalization rate of A limited is 20%. So this is KE of unlevered firm as well as how levered? This is KE of unlevered firm as well as what? Cost of capital of unlevered firm. Calculate the average value of both the companies and also find out the weighted average cost of capital for both the companies. So listen, here they are not asking us to calculate the cost of equity. But however, we need cost of equity for calculating what? Cost of capital. So here first step is to calculate value of unlevered firm, which is A limited. Then we have to calculate value of B limited. Then cost of equity of levered firm, which is B limited. Then overall cost of capital of B limited. Question number 14. Value of A limited, which is unlevered firm. What is the formula for calculating value of unlevered firm? EBIT into 1 minus T divided by cost of capital, which is nothing but cost of equity in this case. So what is the EBIT of the company? It is 2,50,000. Tax rate is 1 minus 0.3 divided by what is the cost of capital? It is 20%. So 0.2. So what is the total value of A limited? $8,75,000. Clear? Any doubt in this? Next. We have to calculate value of B Limited, which is nothing but the levered firm. Now, what is the formula for calculating value of levered firm? Value of unlevered firm plus debt into tax rate. So, value of unlevered firm is 8,75,000 plus what is the amount of debt? 10 lakh rupees into tax rate given in the question is 30%. So, we get 11,75,000. So 11,75,000 is the value of levered firm. Clears? Any doubt? Next, what do we need to calculate? Cost of equity of levered firm. Cost of equity of levered firm is equal to, what is the formula? Cost of equity of unlevered firm plus cost of equity of unlevered minus cost of debt into debt by equity into 1 minus T. Cost of equity of unlevered firm is how much? Cost of equity of unlevered firm 20% plus 20% minus what is the cost of debt? 12% into debt. What is the amount of debt? 10 lakh. Okay. 10 lakh divided by what is the amount of equity or value of equity? 1175 minus 10 lakh, we get 1,75,000, which is nothing but 1.75 lakhs. So far clear? Any doubt? Did you all understand? Any doubt in this? Did you all understand how did we get 1.75? Clear? Into 1 minus tax rate is how much? 0.3. So what is the cost of equity of levered firm? 52%. Now here cost of equity of levered firm is 52%, but cost of equity of unlevered firm is only 20%. Shareholders of A Limited is expecting 20%, but shareholders of B Limited is expecting 52%. Why? Because out of total value is only 11,75,000. Out of that 11,75,000, 10 lakh rupees is debt. They are using only 1,75,000 rupees of equity. So financial risk is high, so equity shareholders expect higher amount of return. Clear? Any doubt? Next, what is the fourth step? Calculation of cost of capital of B Limited So what is the format? Source, funds, weights, then we have to write cost of the individual components, then weight into cost. So here we have two sources, one is debt and the other one is equity. Value of debt is 10 lakh, value of equity is 1.75 lakhs. So what is the total value of the firm? It was 11.75 lakhs. What is the weight of debt and weight of equity? 85.1%. So this has to be 14.9%. So what is the cost of debt? This is 100%. What is the cost of debt in this case? Cost of debt 12 into 1 minus 0.3. Don't take 12% directly. So 12 into 0.7 we get 8.4%. Cost of equity is 52%. So 85.1 into 8.4%. How much? This is 7.15%, and here 7.48%. 7.748%. So 7.748 plus 7.15 we get 14.9%. 898%. Clear? Did everyone get this answer? Any doubt in this? Clear? Everyone done till this point? Clear? So any doubt in MM approach with taxation? So listen, question number 15, question number 16 and question number 17 you can take it as your homework, right? See, listen, question number 15 and 16, both the questions are similar. You can see the requirements: first market value, then market value, then cost of equity, here also cost of equity, weighted average cost of capital, here also weighted average cost of capital. So this is similar to the 11th question. So question number 11, question number 15 and question number 16 are same. So you can take these three questions as homework, or else we will do one thing. Question number 17 you solve it in the class, because this includes MM without tax and MM. This is MM without tax and this is MM with tax. So question number 17 we can solve it in the class. Question number 18 we already did. Yesterday itself we solved it. Question number 18, right? Question number 19 you can take it as a homework. This is very simple. So question number 17 you solve and tell me the answers quickly. Cost of equity is nothing but cost of capital for 3 units. They don't have any debt, right? So 18% is their cost of capital asset. So what is the value of 3 units? 18 lakh by 18%. How much do you get? What is your right? What is the value of 3 units? Then what is the value of 3 units? Cost of equity, sorry, overall cost of capital in first case is 18%. Listen, everyone done with both the requirements? You want me to solve it? So requirement A is approach without taxation, right? What is the formula for calculating value of the firm? EBIT by cost of capital. So EBIT in this question is, we are doing it for B limited first. B limited 18 lakh divided by cost of capital is 0.18. So we get 1 crore actually. 1 crore rupees. Now since it is an irrelevant theory, value of levered firm should be equal to value of unlevered firm. That is what we studied, no? Approach without taxation. Value of levered firm is equal to value of unlevered firm. Tip is there, correct? So what? I'm not talking about value of equity. We are talking about value of the total firm. See, approach without taxation is similar to net operating income approach, which is an irrelevant theory. So where value of both the firms should be the same, whether the company is having debt or not doesn't matter. So value of B limited should be equal to value of A limited. So 1 crore is equal to 1 crore. Value of both the companies are same. Now what is the second requirement? We have to calculate equity capitalization rate. So we have to calculate cost of equity of levered firm only. Unlevered firm it is given. So levered firm cost of equity is, what is the formula? Cost of equity of unlevered firm plus cost of equity of unlevered minus cost of debt into debt by equity. Clear? Now cost of equity of unlevered firm is how much? 18% plus cost of equity of unlevered firm is 18 minus cost of debt is 12% into debt is 54 lakh divided by what is the amount of equity? Total value is 1 crore, out of which 54 lakh is debt. So remaining 46 lakh is equity. So what is the cost of equity? Levered firm 25.04%. Clears? Next we have to calculate the overall capitalization rate, which is weighted average cost of capital. So here we know that value of firm is equal to EBIT by cost of capital. So cost of capital is equal to EBIT by value of firm. So cost of capital is equal to, what is EBIT? 18 lakh. Value of firm is 1 crore. We get cost of capital as 18%. Clear? Any doubt on this? Shall we move to the next topic? Right. So write on the next topic, indifference point. Write down indifference point. Now we are done with all the capital structure theories. All the 5 capital structure theories are done. Now we are going to start with EBIT EPS analysis, which is the second part of this chapter. Write down indifference point. Indifference point, write it down. Now listen, indifference point refers to that level of EBIT at which EPS would be same irrespective of the method of financing the new funds requirement. So what they are saying is, for example, let's say a company needs 10 lakh rupees of additional capital, right? The company needs to raise another 10 lakh rupees of capital, and there are 2 financial plans for raising this 10 lakh rupees of capital. There are 2 plans. So the first plan is 5 lakh rupees debt and 5 lakh rupees equity. And the second financial plan is no debt, the total 10 lakh rupees in the form of equity only. Clear? So for raising additional capital, we have two different financial plans. Now, at some level of EBIT, EPS under plan 1 is also, let's say, rupees 5 per share, and EPS under plan 2 is also, let's say, same rupees 5 per share. Now the level of EBIT at which EPS under both the plans are same, that level of EBIT is nothing but indifference point. Clear? Any doubt in this? So indifference point is nothing but the level of EBIT where EPS under two financial plans are same. Clear? Any doubt in this? So now read it again. It refers to that level of EBIT at which EPS would be same irrespective of the method of financing. In one plan we are financing it through debt as well as equity. In the other plan we are financing it only through equity. There is no debt component. Clear? Any doubt? What is indifference point? Clear? Now look at this graph. So in this graph on x-axis what we are having? What is there on the x-axis in this graph? EBIT or EPS? You tell me. What is there on the x-axis? EBIT. So on y-axis we are having EPS, right? EBIT depends upon EPS or EPS depends upon EBIT? EPS depends upon EBIT. So EBIT is independent variable or dependent variable? Independent variable. So x-axis should always have the independent variable and y-axis should always have the dependent variable, right? Since EPS depends upon EBIT, we are writing EPS on the y-axis and EBIT on the x-axis. Clear? Any doubt in this? Now, so here this is the equity plan where the additional capital is raised only in the form of equity. No debt is used. Now we have one more plan, that is debt plan. Now equity line is starting from here, origin, but debt plan is starting from here. Why? That we will discuss later. Right? That is a different topic that we will discuss later. So equity line is starting from here and debt line is starting from here. Now when you look at this graph, you can see that at this level of EBIT, EPS under both the plans are same. Under debt plan as well as under the equity plan, EPS is same under this level of EBIT. So this level of EBIT is known as what? The indifference point. So indifference point is nothing but the level of EBIT at which EPS would be same under different financial plans. Is this clear? Any doubt in this? What is EBIT? What is your doubt? Last second bench. Got it? Now what is the purpose of doing this indifference point? Listen. At this indifference point level, you will choose debt option or equity option for additional finance. Which one you will choose? You are indifferent between both the plans, right? Why? Because whether you are choosing debt or equity doesn't matter. It is going to give you the same amount of EPS, right? So at this point of, or at indifference point, you are indifferent between equity and debt source of financing. Clear? But let's say your EBIT is somewhere here. Your EBIT is more than the indifference point. At this level of EBIT, which plan you will choose? You will choose equity plan or debt plan? Debt plan. Why? Because EPS under debt plan is greater than the EPS under equity plan. Clear? Let's say your EBIT is somewhere here. Now which plan you will choose? Equity plan or debt plan? You will choose equity plan. Why? Because EPS under equity plan is greater than the EPS under the debt plan. Clear? Any doubt in this? So what is important to understand is at indifference point you are indifferent between debt option and equity option. But once you cross the indifference point, if your EBIT is greater than the indifference point, it is beneficial to have debt in the capital structure. But if your EBIT is less than the indifference point, it is better to have equity in the capital structure. In this case, it is better to avoid debt. In this case, it is better to use debt in the capital structure. Clear? Any doubt in this? Did you all understand? Clear? You got it? Want me to explain it once again? Which one? Which point? Total, fully. Did you understand what is indifference point? So at indifference, sorry? Correct. So listen, at indifference point, you are indifferent between debt option and equity option. Why? Because at indifference point, you are indifferent between debt and equity option because EPS under both the plans are same. But if you are taking an EBIT level that is greater than the indifference point, you can see that at this level of EBIT, EPS under debt plan is greater than the EPS under equity plan. So in this case, it is better to go with debt. So if EBIT is greater than the indifference point, it is better to have debt in the capital structure. But you take a level of EBIT that is lesser than the indifference point at this point, the EPS under debt plan is only this much. But EPS under equity plan is somewhere here. So when your EBIT is less than indifference point, it is better to have equity in the capital structure. But when your EBIT is greater than the indifference point, it is better to have debt in the capital structure. Clear? Any doubt in this? Did you all understand? Now there is a formula for calculating indifference point. This is the formula given in the textbook, but we will write it in a different way. Write down indifference point. Indifference point. So listen, what is indifference point? It is the level of EBIT at which EPS under both the financial plans are same, right? So I can say that indifference point is nothing but the level of EBIT where EPS under plan 1 is equal to EPS under plan 2. Clear? Now what is the formula for calculating EPS? Earnings per share formula. So EPS under plan 1 is equal to EPS under plan 2. This is nothing but indifference point. What is the formula for calculating EPS? Profit after tax divided by number of outstanding shares. So I can write it as profit under plan 1, profit after tax under plan 1 divided by number of outstanding shares under plan 1 is equal to profit after tax under plan 2 divided by number of outstanding shares under plan 2. So far clear? Any doubt? Now listen, profit after tax can be written as what? How profit after tax can be calculated? EBIT minus interest into 1 minus tax rate. You just need to remove the tax from the EBT figure. See, first EBIT minus interest gives you what? EBT. From EBT you have to subtract tax rate. So if you are multiplying EBT with 1 minus T, you get EAT, right? So listen, EBIT minus interest gives you EBT. From that you have to remove the tax, which can be done by multiplying it with 1 minus T. Now listen, in case of preference dividend, you have to subtract the preference dividend as well. Whole divided by number of outstanding shares. So all these figures are relating to plan 1. You have to equate it with plan 2 figures, EBIT minus interest into 1 minus T minus preference dividend divided by number of outstanding shares. So this is the formula for calculating indifference point. Clear? Any doubt? So here basically we are equating the EPS between two financial plans. Got it? Did you all understand till this part? In your textbook they have not included that preference dividend portion, but usually preference dividend needs to be taken into account in case if it is given in the question. Did everyone copy down till this formula? Now listen, there is something called no indifference point and multiple indifference point. See, no indifference point and multiple indifference point, it is not very much relevant for your exam perspective. From your exam perspective, it is not very much relevant. No indifference point will come into picture while solving study material questions, and there is only one question where multiple indifference point case will come, and that is not there in your study material, which is there in the previous year question paper, right? I have included that question in the material, so we will discuss it along with the question. Because if you want me to explain no indifference point, just a minute. If you want me to explain no indifference point and multiple indifference point, it will take more than 45 minutes to 1 hour. It will take. There is no point in spending 45 minutes to 1 hour in a topic which is not going to be tested in your exam. And for no indifference point only, they have given the example in your study material. For multiple indifference point, even ICAI did not give one example, but I have included that example which is not relevant for your exam. But if you want quickly, I can explain it after completing all the questions in the material. Right? Done? Shall we start with the concept analyzers? Copy down the formula quickly. We will start with the concept analyzers. Done the formula? Listen, write down concept analyzers, indifference point. Listen, Excel method provides you the following information. The total funds required is 10 lakh. So 10 lakh is nothing but the additional amount of finance that is required. So for this they have three financial plans. This 10 lakh rupees of additional capital can be raised using three different financial plans. In plan 1, the company is planning to raise 100% equity shares, which means no debt, no preference share capital. No debt and no preference share capital as well. So 100% equity shares of rupees 100 each. And the current market price is rupees 26 and flotation cost is rupees 1 per share. So at what price the equity shares are issued? 11, 10, 9. What is the market price? 26. Usually the equity shares will be issued at the current market price or lower than the current market price. In this question, issue price is not given. So what we have to assume? It is issued at the current market price, but the company is going to incur a flotation cost of 1 rupee. So issue price or net proceeds is 25. So net proceeds is equal to rupees 25. Clear? Any doubt in this? Rupees 25 per share. Any doubt in this so far? Now, what is the total amount of capital the company wants to raise? 10 lakh rupees. So if one equity share is issued at rupees 25, then how many equity shares needs to be issued to raise capital worth of 10 lakh? 10 lakh by 25, we get 40,000. So 40,000 equity shares needs to be issued. So under financial plan 1, what is the number of outstanding shares? 40,000 shares. Is this point clear, or you want me to explain it again? Clear to everyone? Understood? Understood? Next, second financial plan. The company is planning to raise 40% of the finance using equity shares of rupees 10 each, and current market price is rupees 21. Flotation cost is rupees 1 per share. So 40% is raised using equity share capital means, so what is the amount raised using equity share capital? 4 lakh rupees. So remaining 6 lakh in the form of 10% debentures. So now what is the net proceeds in under financial plan 2? It is 20 rupees per share. Why? Because market price is 21 minus flotation cost of 1. So the company will receive 20 rupees for one equity share. Then how many equity shares needs to be issued? How many equity shares needs to be issued for raising capital worth of not 10 lakh, here it is how much? 4 lakh rupees. 4 lakh. So 4 lakh by 20, how much do we get? 20,000. Clear? Any doubt in this? Did you all understand till this part? Next, financial plan 3. Same 40,000 equity shares of rupees 10 each. Premium in market 110%, and flotation cost per share is rupees 1. Now, first you tell me at what price the equity shares are issued. What is the face value? 10. It is issued at 110% premium. So at what price it is issued? 10 rupees is the face value. On top of that, it is issued at, what is the premium portion? 110% of face value. How much do we get? 10 plus 11. So at what price it is issued? 21 rupees it is issued. Is this part clear? Any doubt in this? So it is issued at 21 rupees, but there is a flotation cost of 1 rupee. So the company effectively received 20 rupees. Clear? Now what is the number of outstanding shares in case 3? Value of one share is 20. What is the total amount of equity share capital the company is raising? In plan 3? 4 lakh. So 4 lakh by 20 we get same 20,000. So number of outstanding share under plan 1 is how much? 40,000. Plan 2 20. Plan 3 20,000. Clear? Any doubt in this? So now the requirement of the question is, we have to calculate indifference point between plan 1 and plan 2, plan 2 and plan 3, and again plan 1 and plan 3. So totally 3 indifference point we have to calculate. Clear? So write down concept analyzer. Indifference point. So first let's calculate the indifference point between plan 1 and plan 2. So what is the formula? EBIT minus interest under plan 1 into 1 minus tax rate minus preference dividend divided by under plan 1 divided by number of outstanding shares under plan 1. Which calculation? That, however, again we will do it here also. EBIT minus interest under plan 2 into 1 minus T minus preference dividend of plan 2 divided by number of outstanding shares under plan 2. So now listen, what is the EBIT we have to take under plan 1? EBIT is something which we don't know, so we have to calculate. So EBIT minus what is the amount of interest under plan 1? Plan 1 0 interest. Why? Because 100% equity. So EBIT minus 0 into 1 minus what is the tax rate given in the question? 40% into 1 minus 0.4 minus, is there any preference dividend in plan 1? No preference dividend, so that is 0 divided by what is the number of outstanding shares under plan 1? 40,000 we calculated, so divided by 40,000. Did you all understand how did we get 40,000? This one only you want me to show. Okay, listen. So in plan 1, what is the total amount of equity share capital the company is raising? 10 lakh rupees. There is no debt, so total 10 lakh rupees is coming in the form of equity share capital. Now what is the price at which one share is issued? Rupees 25. So if one share is issued at rupees 25, then how many shares needs to be issued to raise capital worth of 10 lakh? 10 lakh by 25 we get 40,000. So number of outstanding shares under plan 1, it is 40,000 is equal to, what is the EBIT under plan 2? We don't know. We are keeping it as EBIT minus what is the interest under plan 2? Interest amount how much? 60,000. Why 60,000? Because out of 10 lakh, 4 lakh is raised in the equity share capital, remaining 6 lakh in the form of 10% debentures. So on 6 lakh you have to pay 10% interest, so it is 60,000 minus, is there any preference dividend in plan 2? No. So again 0 divided by plan 2 number of outstanding shares 20,000. Oh sorry. Into 1 minus tax rate is 0.4 minus preference dividend is 0. So now solve it for EBIT and tell me the numbers. EBIT is equal to how much? This is 2 times, this is 1 time, then cross multiply, calculate and tell me the EBIT. Two EBIT 1,20,000. Is it 1,20,000? In the second plan, we are raising 4 lakh rupees of equity share capital. One share is issued for 20 rupees. So 4 lakh by 20,000. So what is the EBIT? 1,20,000. So when EBIT is equal to 1,20,000 rupees, the company is indifferent between plan 1 and plan 2. Clear? If they are taking plan 1 also, they will get the same amount of EPS. If they are taking plan 2 also, they will get the same amount of EPS. Clear? Now similarly calculate indifference point for plan 2 and plan 3. Plan 2 and 3 I will do, plan 1 and 3 you can do. So again we don't need to write down the formula. EBIT minus interest, EBIT minus, what is the interest under plan 2? It is interest under plan 2 60,000. So EPS under plan 2 is 60,000 into 1 minus tax rate is 1 minus 0.4 minus any preference dividend under plan 2, no, 0 divided by number of outstanding shares is 20,000 is equal to EBIT minus what is interest under plan 3, 40% in the form of debentures and the interest is 10%. So what is the interest amount? 40,000 so EBIT minus 40,000 into 1 minus 0.4 minus, is there any preference dividend in plan 3? There is a preference dividend in plan 3. 15%, 40%, 80%. Oh, sorry. 20% of capital is raised using 15% preference share capital. So what is 20% of 10 lakh? 2 lakh rupees. On 2 lakh rupees, the company should pay 15%. So we get 30,000. So number of outstanding shares under plan 3 is same 20,000. Now listen, you don't need to solve it. Listen, if number of shares under both the plans are same, you cannot calculate the indifference point. There is no indifference point in this case. If number of shares are same under both the plans, indifference point cannot be calculated. This is what we should discuss over here. If number of shares are same, indifference point cannot be calculated. No indifference point is the answer. Right? How did we get 30,000? The company is raising 20% of the finance using preference dividend. 20% of the capital using preference dividend. What is the total capital required? 10 lakh. On 10 lakh, 20% is coming in the form of preference dividend. So on the 2 lakh rupees, 20% of 10 lakh, on 2 lakh rupees, they have to pay 15% dividend. So 30,000. Clear? Did you all understand this part? Why there is no indifference point? If number of equity shares are same under both the plans, indifference point cannot be calculated. Even if you want, you try it, EBIT will cancel out in that case. If you try to solve it, EBIT and EBIT will get cancelled out. So you cannot calculate it. Done? So don't waste your time on calculating this because your indifference point cannot be determined. Calculate indifference point between plan 1 and plan 3. So we can answer the calculating So indifference point between plan 1 and 3 is 1,80,000. So if you are done till this point, you can go for lunch break. We can start at 2 o'clock.
Kavi Bharati.
Sir, is it recording or not recording?
It's recording.
Yeah, that's recording.
Recording. If I can't stop recording, it will stop.
It's great, Moana.
Move forward while watching the recording. Because if I click stop recording, it won't pause. It will stop and it
There's
will
no
get
pause.
saved. There is no pause.
That's why Anand sir has it part wise.
So look at question number 20. Best of Luck Limited, a profit-making company, has a paid-up capital of 100 lakh rupees, consisting of rupees 10 lakh ordinary shares of rupees 10 each. Currently it is earning an annual pre-tax profit of rupees 60 lakh. So what is the 60 lakh? Annual pre-tax profit. The 60 lakh is nothing but EBIT of the company is 60 lakh. The company's shares are listed and are quoted in the range of rupees 50 to 80 rupees. So the market price of the company is ranging between 50 to 80 rupees. The management wants to diversify production and has approved a project which will cost 50 lakh rupees, which is expected to yield a pre-tax income of rupees 40 lakhs per annum. So what is the existing EBIT of the company? Existing EBIT is 60 lakh. Now because of undertaking this project, EBIT of the company will increase by 40 lakhs, so that it will increase to 100 lakhs. Clear? Any doubt in this so far? To raise this additional capital, so to raise an additional capital of rupees 50 lakh, the following options are under consideration of the management. To issue equity share capital for the entire additional amount. So what is the additional amount of capital required? 50 lakh rupees. For the 50 lakh rupees, they are planning to issue additional equity share capital. It is expected that the new shares, which has a face value of rupees 100, the new shares can be sold at a premium of rupees 15. So at what price the new shares will be issued? 10 rupees is the face value. On top of that, they are planning to issue it at 15 rupees premium. So totally it will be issued at rupees 25. Clear? Any doubt in this so far? Second plan is to issue 16% non-convertible debenture of rupees 100 each for the entire amount. So first option is a 100% equity option, whereas second option is a 100% debt option. So they are planning to issue 50 lakh rupees of debentures with 16% coupon rate. Plan 3 is to issue equity share capital of rupees 25 lakh, which has a face value of rupees 10, and 16% non-convertible debentures for the balance amount. So third plan is 50% equity and 50% debt. So they are planning to issue 25 lakh rupees of equity and another 25 lakh rupees of debt. In this case, the company can issue shares at a premium of rupees 40 each. So at what price the equity shares will be issued? Face value is 10. On top of that, there is a premium of 40 rupees. So totally it will be issued at rupees 50 per share. You are required to advise the management as to how additional can be raised, keeping in mind that the management wants to maximize the earnings per share and to maintain its goodwill. The company is paying 50% tax. So what is the requirement of the question? They are asking us to calculate. So here basically we have three financial plans: plan A, plan B and plan C. Under each of the financial plans we have to calculate the EPS, and we will choose the plan which is giving us the highest amount of EPS. Clear? Any doubt in this? So question number 20. Write down the first working note. Working note 1. Calculation of number of outstanding shares. Calculation of number of outstanding shares under each of the financial plans. Under each of the financial plans. So look at the first line of the question. Best of Luck Limited, a profit-making company, has a paid-up capital of rupees 100 lakh, consisting of rupees 10 lakh they have given. No, it is not actually rupees 10 lakh. It is 10 lakh shares, and face value of one share is rupees 10. So 10 lakh into 10, 100 lakhs. So that is the total value of the equity share capital. Actually, it is a printing mistake. It is not rupees 10 lakh. It is 10 lakh outstanding shares. Is this part clear? Any doubt on this? So we have to calculate number of outstanding shares under each of the financial plan. Plan A, Plan B and Plan C. So here, what is the existing number of outstanding shares? Existing number of outstanding shares is equal to how much? Look at the question and tell what is the existing number of outstanding shares. The company has a paid up capital of how many rupees? 100 lakh rupees, consisting of 10 lakh ordinary shares of rupees 10 each. So what is the outstanding shares? 10 lakh. So under each of the financial plans they have 10 lakh outstanding shares. So this is the existing outstanding shares. Clear so far? Any doubt? Now listen. Under financial plan A, they are planning to issue additional equity share capital of how many rupees? 50 lakh rupees, and each share is issued at a price of rupees 25. So here, if value of one share is 25 rupees, then how many shares needs to be issued to raise equity share capital worth of 50 lakh? Just cross multiply. How much do we get? So new shares. So here we get 2 lakh shares. Is this calculation clear to everyone? This 2 lakh is nothing but 50 lakh divided by 25. So what is the total share under plan A? 10 lakh existing and 2 lakh new shares. So totally it is 12 lakh outstanding shares. Clear? Any doubt in this calculation? So far clear to everyone? Next, under plan B also they are having existing shares of, they are having existing 10 lakh shares. Under plan B, are they issuing any new equity share capital? No. So number of new shares will be 0. So number of new shares will be